Started up. All right, y'all. We got Textbook Tuesday going on right now. The topic of discussion. Thank you to Tev for giving us our first topic to jump into, which is volume spread analysis. And volume spread analysis, or VSA, is a tool that I use primarily to gauge what phase a market is in, and we've got the phases listed kind of here. And these are the phases of activity of, we call it the composite operator or the CO. So the composite operator, in theory, and in the way I want you guys to think about this is no matter how much any one individual has of an asset, they may have a lot of it. When we talk about stocks, there's somebody who owns the company who has majority, who's the majority shareholder of that stock. Let's say it's Amazon, so we know that's Jeff Bezos. So he's got the majority shares. If he wants to sell Amazon to another person, they would become the majority shareholder. Like you can think Mark Cuban and the Dallas Mavericks. But regardless to what that one person is doing with the money, they probably have a bunch of other cohorts and colleagues that follow along very closely to what they do. So in the grand scheme, there could be a number of parties, a number of institutions, a number or a syndicated group of traders that trade a particular asset class. And while they're trading that particular asset class, they all have the same viewpoint, which means they're all going to think in the same way and they're all going to allocate their funds in the same way, whether that be to buy them or sell them. It just all depends on really that group and that composite operator's take on the market, right? They may know something that nobody else knows, which makes them want to buy in at a lower price. Now, when they do that, when they buy in at said price level, they're going to buy in with so much of that stock or that asset that it's going to cause the market to fluctuate. And if they want to hide their positions, if they want to get their discount and not show the public that that is the discounted level, that they're really interested in just removing all of the floating supply in that market at that level, then they'll try to do something called conditioning the market. With volume spread analysis, we're able to see those conditions, right? We're able to see those stopping actions. We're able to see them kind of volley and rebound price back and forth in those consolidations. And if you guys saw my stories on Instagram or on Facebook or wherever it's trickling around on social media, you'll know that the market is comprised of, and we talked about this very briefly, and this is an introductory call, the Textbook Tuesday call is for my newbies. So markets are comprised of uptrends, downtrends, and consolidating markets. Okay. The difference of each is the structure, and that's what we talk market structure. And we can talk about the slope of these trend channels that I'm drawing. This one is an upward sloping trend channel. The trend channel is the blue that I just drew. The uptrend is the red line that I just drew. So an uptrend will have an upward slope. It'll have from point zero to point one will denote as a higher high, or just HH, and the lows will be a higher low. And then an uptrend consists of consistently higher highs and consistently higher lows, right? And that's the high, and we got a lower low. Oops. Now I want to do the text. All right, perfect. Right. And then lower high, lower low, high, lower low, right? So these are the market structures that we know through Dow theory. Markets moving uptrends, downtrends, and then consolidations or ranges, range bound markets, right? And when we talk about a price range, we're talking about specific prices, right? These are things that we can see tangibly. Like right now, we're at the 82 dollar range, and then this would be like 82.50, right? We're looking at here on the 5 minute time frame, but for math's sake, we're just gonna say this is a 50 cent price range. Okay. So as prices move in any of these conditions, we have to sit and think what causes a market to move in a bullish manner or a bearish manner or just sideways. And a lot of people will say, oh, there's more buyers and sellers in that uptrending market, or there's more sellers than buyers in this downtrending market, or the buyers and sellers are equal in this consolidating market. But the consolidation from a volume spread analyst perspective, it paints the picture. It paints what the rest of the market participants are not seeing. So that's why I utilize this as one of my strongest edges. It's top three for locating good trades and timing the proper trades. And like I talked about, the reason why it's so efficient for me is because I literally follow the footprints of that large operator, of that syndicated group, because I don't make any moves until they show me that they're really interested in this asset, or when they show me their lack of interest in this asset. So right here, we got the CO actions in a trading range where they create a sweet spot and also show their hand for the most part. Right? They show their aggression in buying and selling, and that's what activity shows us. That's what volume shows us. It shows us the activity at a specific time and a specific price that will allow us to say, hey, yeah, this is the direction the market is more likely than not to go, even in a consolidation. So this, what you guys are seeing, these diagrams and the verbiage is from the Wyckoff Trading Group, hosted by Roman Bagamazov, Hank Pruden, those guys. This is where I'm getting the text from. So if you guys want to go and expound on some of that knowledge, you can go on stockcharts.com and find some of their literature. You can even get in contact with them. They're all over the internet. You can see the WTC, Wyckoff Trading Group there. So if you want more information on where I got this information, you can go find it there. But for explanation's sake and how I utilize volume, and you guys can see the ultra high volume bars and all these bars up here at the top, if you're following the diagram, I utilize these in my trading every day. It's my bread and butter. So we talked about who is in control of every market. Is the person with the most and the group of people that are following that person around. But how do we see their interactions with the market? How do we perceive those? So with volume spread analysis, we can see when that large 500,000 unit position is placed within the market. Because here's the question, right? And I had a high net worth individual contact me not too long ago. They wanted to buy $1 million worth of Bitcoin. Okay, I did the currency conversions. It's gonna be this much at this price level. But wait, before you hit that button, the market, and this is around the $100,000 level. So you guys go back in time, we'll look at that and see around the time frame or whatever. But while it was creeping up to about 110, 107, I got this call. And the thing I wanted to tell them is, hey, if you put $1 million worth of anything into any asset, it's going to fluctuate the price. And the second you buy it, somebody else has to sell it to you. And that amount of selling could cause a chain reaction and could cause the market to continue to push lower. In order to buy something, you have to have a seller. In order for a contract, any contract, there has to be a buyer and a seller. If you want to go buy a car, you have to sign a contract. The dealership has to sell you the car. You are the buyer, or your bank is the buyer, and they have to make those connections. So for every buyer, there's a seller. That's a contract. In order to ensure, like we talked about, that you can get the correct price and not a price that is so far away from the price that you wanted to buy it from. If you can get something at a wholesale value, you want to keep it at that wholesale value. You'll keep going to that gas station that has the cheapest price. You'll keep going to that grocery store that has what you can buy in bulk for cheap. You'll keep doing those things as long as you can get those prices. If the prices move too far from your preferred price level, then you no longer get that discount. And it goes from wholesale to retail pricing. And then an upcharged price at that. So in this phase here, phase A, right? And I'll denote these with this line here. In phase A, they're going to stop the trend. And this is where we're looking at this sideways structure, and we're really able to decipher where things are going to go because the market is only trending in these two conditions probably about 30% of the time. The rest of the time is creating a pause. And another thing, with volume spread analysis, there are a few things, a few laws that dictate volume spread analysis. So it's the law of effort versus result, the law of cause and effect, and we also have the law of attraction. And then we also have the law of supply and demand, right? And one of my favorites being an economist. And we'll talk about what some of these things mean, right? It's going to be the quantity demanded, right? On the bottom line, this is price. And as price moves, we have things like the level of supply and the amount of demand, right? And these things shift as price goes up, supply increases. More people are likely to want to sell these things at higher prices. As price goes down, demand increases and more people want to buy things at lower prices. So in a sideways market, as we approach the lower price level, demand should increase. As we get to the higher price levels, supply should increase. And those are things that we can see naturally day to day. Like we talked about gas prices, food prices, all of these things. We talk micro and macroeconomics. So the law of supply and demand, very valid. The law of attraction, like attracts like. What people see on TV, what people hear about, what people, hey, did you hear about crypto? That's exactly how I got that phone call. Did you hear about crypto just hit all-time highs? Did you hear these things? Did you hear these things? Yes, I did. Right? Attraction, the law of attraction, it just breeds volatility for these markets. And that's something that volatility in a short amount of time will show up as ultra high volume or the lack of volume at a certain period of time. The lack of attraction is actually discussed. And if they're not interested in a market, those markets tend to fall on their own weight. And we can look for shorting opportunities there. So knowing these things, law of attraction, law of supply and demand, cause and effect, here we have a phase B, where they create the cause. They're actually creating a cause. And in the markets, the cause is the size of the structure, the size of that market structure, the size of that consolidation. There will also be news saying all types of things. Oh, the Strait of Hormuz is shut down, or they're opening back up, or it's a ceasefire, or we're going to go back to war, or they're sitting here creating a cause, which allows for supply and demand, these different battles to take place at the resistance, to take place at the support. Wow, that's so crazy that that just lined right up with the rebound of stocks as it hit a bottom. That's crazy that that happened like that. Or fear left the market the second we got to a certain level at the VIX, right? Once it got to about 35 on the VIX, everybody was relieved of all that fear all of a sudden, and risk was just right back on. It's those things that we can relate to the law of cause and effect. Next, we have the law of effort versus result. If the volume is going up in the upward direction, that's harmony. If it's going up in the downward direction, that's harmony, right? But if volume is going up in the up direction, but then price is going down, then that's disharmony. And that's something that we can see through the law of effort versus result. And you'll see World Cup trading champions have used that first law of effort versus result to win the World Cup and to navigate their way through trading, which is another reason why volume spread analysis is one of my keys to my success as a trader so far, and getting into some of the most prestigious proprietary trading institutions um, in America. So these places are Forbes listed as well. So these are just things, the four laws that I want you guys to think about. The law of supply and demand. Supply increases when price goes up, demand increases when price goes down. That should happen, right? But if we break the lows, right, then that is a contradiction of that law. And you cannot put a narrative, a bullish narrative on a bearish chart. Okay, and I want you guys to understand those tipping points are what get us into and out of trades and help us shift our bias so we don't get anchored in the wrong position. Okay, so remember, phase A is stopping the trend. This was, like I talked about before, if you want to put $1 million of anything in there, you're not going to put it all in at one point. You put it all in there, it's going to move the market way too far, and it's gonna be obvious that that's what you're trying to do. So if we look at phase A through the verbiage, the CO grabs a significant amount of shares as the public dumps the stocks in fear, right? That fear is fueled by the law of attraction and cause and effect through the news, through whatever. As prices are low, and more importantly, volatility allows the composite operator to accumulate large blocks of the stock, right? Here they buy 500,000 units. That 500,000 units shows up in a short period of time, and that shows up on volume, especially here on the lower time frames. You can't hide 500,000 units on a lower time frame. On a daily, yeah, you definitely could, right? But on the 5 minute, you can't, right? So that's why I come down here for um my final entry analysis on the 5 minute. Even though I do a multi-time frame, higher time frame analysis, my entry time frame is here on the 5 minute, where you'll see these structures show up perfectly. And it's like a ripple effect, right? So it starts off as a drop in a bucket or a drop of water into the ocean. That water ripples out. That ripple turns into a wave. That wave swells up and somebody can surf on it, right? We start from the very, very, very smallest fractal point, and then it propagates itself out, right? So we get that move to the downside, they buy in, that buy-in causes the stopping action, right? The price is then supported, but then they sell some of their holdings at a resistance to create that level. They say, hold on, we don't want everybody to hurry up and join in. We don't want the public to join in and start pushing price way past our discount down there at the selling climax, this SC point. We don't want everybody to go down there, right? But we don't want everybody to push price any higher. So they'll sell some of their holdings, right? 500,000, they make money on the way up, sell some of it on the way down. They're still holding 300,000 positive orders here, but they sell 200,000 of it. That 200,000 unit sale pushes price down. These sellers that were still here are like, okay, the sale is going to continue. So they sell in. When they sell in on phase B, the CO continues to accumulate once the price reaches the support level, and they have enough to counteract whatever selling is on top of that. Along with that, they're closing their sales. And as you can see, they're both buyers and sellers in this. So they're selling from the highs, making money on the way down, buying from the lows, making money on the way up. They're basically hedging their own positions to keep price within this range. Whole time, we're thinking Dow theory. Oh, it's because nobody's interested. Oh, they're interested, but they want everybody else to lose interest in the market. So as that continues to push the market in this sideways pattern, they continue to buy and sell until they get to a point here, phase C, right? Phase C is like the spring move. It's a springboard. It's like you take something on a side of on a spoon. You hold one end, you fling it across the room, right? That's how they move price. When they're ready to go, the biggest distinction is after a sign of strength or a sign of weakness, they're not going to want to sell any of their holdings this time, which is going to cause the breakout to the upside, which is going to create that sign of strength all the way throughout the range through phase D right here. Phase D is what we're looking at here. Okay, phase D. We're here in between phase C and phase D. Here is where the biggest distinction will be, right? They cannot hide their aggression, right? They can't hide how aggressively they're buying this asset, right? At one point, they were both buyers and sellers. At this point, they're only net buyers. So you'll see nothing but positive harmony in volume and price. It may not be ultra high, but it will be relatively high volume in relation to price, and the price bar is moving in a much more fluid way throughout that market. It's called a change of behavior, a change of character. Okay. Once you get to that point where phase E trend out of the range and the trend gets out of the range, let me see if I can. I don't know if I can do that. No, I don't think it's gonna let me copy this whole thing. But ultimately, we'll have a move that looks like this, and then it'll either be followed by a move that comes all the way down and breaks out to the downside, or a move that comes out and breaks out to the upside, and then starts the trending condition to either trend bullish or trend bearish. Um, like we talked about, that change of character, that change of behavior is the signal. Once they start moving aggressively in the opposite direction, that's when we can start to say, hey, yeah, this is a good chance, a good time to buy. And then we have what we call the backup action, the back to the creek, the backing up action, where that's our sweet spot, where we confirm the strength of the rally or confirm the strength of the breakdown and continue on with that move. So when people ask me, well, Jay, when should I buy? Around this time frame, right? It's the safest time that I can tell you. A lot of people want to try to get in during the spring, but that's hard to kind of find a market bottom. It's easier to locate the bottom after it's already shown itself, after it's already in the market. You know what I mean? We're looking in hindsight, and that's there, and we're able to see this pullback. We'll be able to run a Fibonacci on that move and do the rest, and we'll be able to see that extension through the price range. That's what we want to see before we make that move. We want to have clear indication that that is what the composite operator is no longer actually trying to hide. By the time we get to this back to the creek move, you'll have seen some people saying, "Oh yeah, I'm up so and so percent," and then it gets on the TV, phase E, and everything else. But by the time it gets on the TV, we're already at this highest point in the market, and that's where things start to topple off. And then we get the same exact structure, just upside down. So that's volume spread analysis in a nutshell. But the way it is perceived, right? We have our high and low, our open, high, low, and close of a price bar. And based on the volume, is the volume ultra high or is the volume really low on that bar? That's how we kind of gauge, not kind of, that's exactly how we gauge the the level of effort and the level of result. So effort is in the volume, result is in the price bar. Increase volume, increase effort, result in the price bar. If the price bar shows a lack of effort or a lack of result, that effort and result is in disharmony. And we look at those things at certain points and at certain times in the market. When we have a macro event, we know that macro event will be a lot of effort, and we want to gauge the result and see what comes out of that. So at its easiest forms, that's what volume spread analysis is. It's looking at the volume in a price bar and the effort and the result. So volume of the price bar plus some of the other things that we talked about. So here is a trade that I took. This was April 7th, a couple weeks ago. This is the Kiwi. I think we had a Kiwi monetary policy statement. It was around this time, yep, 7 o'clock. We have the effort versus result picture. As you guys can see, we have what we would call an uptrending market. We have higher highs and higher lows. As you guys can see, we have this big move to the upside, and with that big move to the upside came volume. Okay, ultra high volume, as you guys can see through these purple bars, the tall bars. Okay, I'm gonna go ahead and denote those with a horizontal ray to see the highs. So we see the highest level here that we saw, and when we see that amount again, we call that analogous volume. This shows us when the large operators showed up. They showed up here, they were bullish, right? We can look at the price bar, the effort shown here, this effort, the effort, and the resulting price bar. So when we look at that resulting price bar in relation to the price range as depicted by the closing prices, the lowest and the highest closing prices, we'll call this, you can even call it this tighter range here. Let me do this here. This tight price range here. Well, you can see they at 91,300 and at 91,115 are the highs and lows that they chose to use for these prices. I want you guys to see this price here and this price here. I can even turn on the pivots. I'm not sure how many pivots they're gonna have. All right, perfect. Not so many pivots. So as we're sitting here looking at the pivots, 91,306, 91,113, 91,294, 91,165, we can definitely say the the lows are increasing and the highs are also decreasing though. But the definitive move here was when this ultra high volume bar showed up at 1245. It has the highest volume that we've seen in the previous, this entire price chart, right? So that's the previous 137 bars. So we've broken the highs from the previous 137 bars or 11 hours. So this one bar has now completely erased any bearish sentiment for the past 11 hours in one single bar. The effort and the result validated. The next bar continued to go higher, right? Which shows that slight continuation. Now we have a bar. Supply does show up in the market because remember, the law of supply and demand states that as price goes up, so does supply. Supply does introduce itself in this market, but it's not enough to make it to 50% to halfway below that previous bar before prices reverse and continue to make higher highs, continuing
Hmm.
on and actually creating this uptrend, creating a similar change of character. But we know as a sign of strength shows up, like we talked about, there will be a backing up action. The sweet spot for this move back here was back at the 306 range. Pretty peculiar. They used the same price here as they did here, right? Volume spread analysis. All right. We can find the specific prices. We can find the the timing, the area, the sweet spot. We can locate the highs and the lows and create a narrative that gives us an opportunity to make six times, eight times the amount of profit. And when we talk about what we do, anybody does for a living, you're spending your time doing that, and the market can make a substantial amount of money in a short period of time in 2 hours. So because we have one bar that eclipsed 11 hours worth of sentiment and data in 5 minutes, now we can locate, and this is 12:45. They had the next move an hour and a half later at 2 o'clock. Now I don't trade the 2 o'clock candles. This is them jacking up the spread and doing a whole bunch of other things. But by 3:30, this move is a go. We got the ultra high volume showing up. That's the aggression from the large operators. They're also buying, and then they push us into the monetary policy statement. Again, not the highest amount of volume, but that lack of downward interest here. This bar, if we look at this, we can see the high volume, but like I talked about before, there's also things to be said about the low volume. This is the lowest volume bar from the lowest volume bar in the previous. We haven't had anything this low since probably this bar. 6 hours. It's the lowest volume in the past 6 hours. And that last bar that was that low was the bar that came after the ultra high volume bar. So with this amount of lack of interest to downside pressure, we didn't break the lows of the previous, the 767, not 782. It's still higher than the previous pivot low. And then we make a higher pivot low above that, which shows a lack and an even lower move to the downside, lower volume, lower interest move to the downside, which shows a lack of supply and demand continues to move up in that market. And it did. And as we back out, we can still see that demand was in control of this Kiwi yen market. So that's some of the ways that I utilize volume spread analysis. This was a trade that I took in my institutional account. Um, and we have all of the reasons, right? The law of attraction, we have a macro economic event, the law of effort versus result. We saw the effort to the downside was lacking, the result lacking, lackluster, which gave us the indication that supply was diminishing and demand stepped back in and continued to push prices up, which matched our effort result. It matched our cause and effect. It matched our everything. So, with that being said, I'm gonna go ahead and stop the video on this. This will be the first episode of Textbook Tuesday. You guys bring your questions. I'll bring the answers. Tev, real quick, does that answer your question? Is there anything else?
No, that's good. I cleared it up for me, and then the examples made it even more clear.
I appreciate that. I appreciate hearing that from
Yeah,
you.
like going
So,
back in and because it was a little confusing until you went and showed those two examples of all right here, then you look at this bar, look at the movement after the bar, and then the
Mhm.
next ultra high volume bar. Where is it? What structure are you in? Are you breaking structure? That was a real clear explanation for me.
Yeah. And here's another thing, man. So, like we talked about before, as I put this over the top of this bar and I'm looking at how much more bullish it is and everything else, if you want, you can take a trend channel, put it at the either the close. I do the close. If it's on the way up, I do the close and the low on the way up. And then if it's on the way down, I do the close and the high. Okay. This is your area of interest. I'll change the color of this one to like green or something like that. No, I'm actually not. Okay. So
I can
what I
see it.
could
I can
do,
see it. You good?
yeah, I can use a different color, but I usually do I do a big horizontal ray through here, right, to make it super bold. Right. So with that, when you get this Yao Ming bar, you can line it up like this. And this is the new price range that they set for themselves. They're saying, hey, we're not going any lower than here and here. If it's bullish, they'll stay above 50 and for sure stay above the low here. So again, when it comes to stop loss placement, we know we have that 306 number here that we can utilize. We can use that and then have this shrunk in a little bit tighter and then get a much tighter stop loss. And this is the 5 minute time frame. So you get a much tighter stop loss and a much nastier entry if you want to do that. That's called the trigger bar strategy. And that's from the guys in the UK that do the volume spread analysis, the trade to win. That's their catchphrase, and that's Gavin Holmes, the Tom Williams style of trading there. So that's what they utilize. So yeah, little things there, just the little things that might be a little bit more advanced than for beginners, but for all my newbies that are gonna go back and watch this, I want you guys to know. And like I said before, I'll tell you everybody that taught me everything I know about volume spread analysis is Roman Magomazov, Gavin Holmes, Tom Williams. Those are the three big names, and then you see there's not too many volume spread analysts out here. And all the ones that do it, they either won the World Cup Trading Championship or they do it professionally, and you can find them all over the place. So yeah, that's all I got. I got to get back and do some homework with my son. So you guys be easy. See y'all next Tuesday.
Hell yeah. Appreciate you, man.
Yes,
Appreciate you,
sir.
G.
Gotcha, bubble. Peace. I'll put
Hey,
this on YouTube.
All right.
what's the YouTube channel?
I'll send it to you.
Okay. Um, so when it comes down to volleyball or the VSA,
You
it,
asking me or you asking Jay before
oh
he
shit.
go?
Oh no, I was
He,
asking. Oh, I thought Jay was gone already.
oh no, he's
Uh,
still here for.
I'm here
Oh,
if you need me
oh shit,
real
what's going
quick.
on, family?
What's up, killer?
Chilling, chilling, chilling. I'm with Tim right now. Quick question, because I
Yeah,
came in late with the VSA. I know I heard that you said that with the candle, you would check the candle after the bar in question. Would
absolutely.
that would be so the VSA would be like an extra thing of confirmation in and of itself. It's not going to dictate whether or not it's actually going to have a breakout, but it can be used with the following candle to help dictate whether or not it's the validity of it.
Yep,
Did I understand?
that's the effort versus result picture right there. It's the follow through. Effort and follow through will help you say, yeah, it's gonna keep going that way. But say
Okay.
I had this big upward candle like that at the same resistance, and then the next bar broke down below 50% of that bar and completely erased the bullish sentiment that was there. That's not that's not follow through. That's a fake
Okay.
out.
I was about to say that's a fake out.
Now I could go short. I can change my bias just that quickly with that trigger bar setup that I did too. I'm looking at that bottom bar like you if you go below that, all right, you you've changed your structure, you've changed the narrative, you've changed my perspective. I can't go bullish against this. I'm looking for that sign of strength, the backup, because I know supply is going to introduce itself, but when it does, is it diminished or is it because ooh, here, check this out. I'll put this back up because this is the key. This is clear for you guys here. If you see this, you see this bar, you see the screen now.
Yes.
If you look at this down bar that I have highlighted, the one that came down and the low is 306. This bar right here tells me so much more than the big bar ahead of it. Look at the effort, right? The effort right here. Look at the volume. It's ultra low. Look how little that volume is.
I see.
But then we get a move that goes and it pushes all the way down, damn near to the bottom. If this was like a volume, either the old school volume knobs, you push it all the way down, right?
Okay.
You push it down, and you expect the sound to go off, but then you still hear sound. You're like, oh, my button's broke. Hey, you know what I'm saying? Or you hit
Yeah.
the brakes of the car, you slam on the brakes, you push your foot all the way down, and the car still starts moving forward. You would think, like, wait, am I going downhill? I thought I was on a flat road. I thought something's not right. There's a oh shit, volume and price aren't matching. There's a disharmony there. If I hit the gas, I expect the car to go. If I hit the brakes, I expect it to stop. But here, there's not very much volume in this price movement. Remember who's buyers and who's sellers. This is actually them taking profit off of the move that they bought from. Aggressive buyers through here, we can tell. Aggressive buying through there. And then the sales, that's not that's not them selling. That's everybody who was selling, everybody that was selling here, that's them getting taken out. Their stops were set up here somewhere. And when you sell, this is actually a buy. In order to get out of the sell, this is a buy stop. This is the sell limit, and this is a sell stop. So this close of a sell is actually fuel for a buy. If they can get people in here trapped selling this low, selling this move like this, then this move becomes an even more aggressive buy because it's them running people's stop losses. And we can see
Mm.
that matching on the way out here. Why is this much more turbulent? Because it's got some of this involved with it. Because people would take this as a fake out, but then not look at how much volume was actually in that sell. None. So it's either going to be an ease of movement and it should break below this low. So now, even if, and this is something big for you guys too, even if you bought in late, like here, and you still put your stop loss down here, you had great stop placement. You would see red in your account, but would you get out after seeing that? That's something that goes into this too. Because when you're actually in the markets and you see money and now you're losing money. Now it's like, oh, if you're staring at the P&L, this could be an issue for you. But like I said before, your stop loss is your guiding light. This level right here, this low, the low is 257. I'd say you put it a pip below the low. So 257, 247, and I can't do 247, so I'd have had 245 in mind. I can only do by fives. It'd have been 245. This one came to 306. You have 5 pips worth of cushion. You're good. It didn't hit your stop. You're golden. No need to change your perspective, change anything until you see something that invalidates your bias. And the bias is validated because this is the last point of support before that big move to the upside. This is them saying, I don't want anybody to go any lower than what we got. We got it. Let's get out of here. That's the that's what volume spread analysis gives you. It's the, oh shit, pack it all up. Here comes the cops. Like, so like we at the dice game, the money's on the table. Yeah, everybody freeze. Oh, get it, let's go.
That's
Like,
funny.
but you got to be able to see that emotion, and that's what volume shows me. And not
Okay.
just anybody's emotion. We could look at everybody's, or we can be very specific to say only the people with a lot of it is who we care about.
So when people get stopped out, do they the do so liquidity? I do understand that liquidity is the essentially the bottom and the top of what's going on right then at that point in time. So when people get stopped out of whatever their trade is, do they become liquidity?
Yeah, essentially, that's what that is. And it's a driving force for this market. Liquidity is how fast you can move and exchange hands in a market, right? How quickly you can exchange one thing for another, how fast you can basically liquidate an asset and turn it into cash and turn it into
Okay.
capital. So as far as the liquidity goes, there's always liquidity in a market. There's liquidity down here because there's when you think about how people buy and sell, right? Once you buy it, even if you're even if you bought it and you left some risk on the table, this little bit amount of risk to match whatever that is, this is liquidity. This little area down here, there's sell side liquidity. They could go and reach down here to come grab that amount of downside liquidity if that's the direction they want to go. As we're sitting here, there's this upside target at 360 that has sellers here. There were sellers up here. This was where supply had overcome demand. These short positions are in profit. They're floating, right? Even if they put their stops in profit and they move them down to some level, right? This is still a sell stop, that sell side liquidity getting pushed further and further down. Once buyers show up, this person selling actually sells it at a lower price and they exit. So that seller's gone. Once that seller leaves, there's no more downward liquidity, no more downward pressure. And then prices start to push back up. For this buyer, as they buy and they move their stop loss up, this buy is still buy side liquidity until it gets sold into and gets taken out. And now that buyer leaves and that seller leaves, and that leaves an open void in the market. And like we talk about here, if I can, I'm just gonna clear everything. I don't know if I'm gonna remove all the drawings, but I remove majority of them for you guys. As we look at this bar again, in particular, we build the concept of that fair value gap, or what they call an imbalance, where this buy happened so fast, these sellers that were up here, they no longer have a chance to sell. Nobody had a chance to buy, nobody had a chance to sell in this gap. But now they can come back to the gap and see who's in the market, right? In this imbalance. And when the sales do come back, were there any more sellers that were picked up and able to push price further down? No, they were eradicated on this buy. These sellers that were here, they probably had their stops in profit. And if they didn't have their stops in profit, That's where this initial upthrust happened. That's them getting turned into buyers because their sales to close a sale, you have to buy. When you sell something, somebody has to buy it. So when that contract closes, those buys show up, and then boom, those sellers are now gone. New sellers that were like, oh, this was the previous highs from before. Look, it's a little bit higher. I can sell this down at a better value, right? So now there's a whole bunch of sellers that show up here and create this sell imbalance, but then nobody else shows up to sell again right here. And you look at this vertical, and look at the volume here, and then look at the volume here. There's still no sellers in this market. And then this little amount of buyers is enough to propel prices to the upside. Hmm. So it lets us know the narrative of who's in the market, who's in control. This whole chunk here just screams the buyers are taking control, right? If we were looking at this from an EMA standpoint, right? You can see the EMA starting to cross over. They crossed over here and they're all pointed up. The 55, the 13, the 21, they're all pointing up. The pivots are getting higher, higher highs, higher lows. We're back to that Dow theory. So that's the little things. And that's what VSA is such a powerful tool. The more you learn about it, the more powerful it gets, even at the beginner levels. Just looking at that will help you counter the market's it's like that weird nature because supply and demand, the law of supply and demand. As price goes up, supply increases. As price goes down, demand increases. It's like this counterintuitive approach, which most people don't even think about. But this puts you in that vehicle. So that's all I really want to tell y'all. I got to get this boy's homework done. He got darn mixed fractions and a darn something else he got to do, and I know he don't know how to do neither one of them.
My bad, fam. Appreciate you.
Y'all good. Y'all good,
And you
family.
said you putting this on the YouTube tonight?
I'm gonna try to, but like I said, I got him till probably about 10:30. I got finish up this inspection report. I got to drive an hour and a half to another inspection tomorrow. I'm gonna get
Woo.
this downloaded, and then I'll throw it I'll throw it into the
I look for it by Friday.
yeah. No, it'll definitely be down there sometime this week, and we'll get them all in. And plus, there'll be more of these throughout the time frame. Next thing on the horn, which was why I didn't jump into it earlier. I'm looking into the CFA level one, level two is like 300 hours of study. Next test is November, so I'm gonna try to get in on that and get the VA since I'm not going to Berkeley. I got it put in there to at least get me certified because there are certain certifications that you can have in lieu of a master's degree or a bachelor's degree. There's certifications that you can hold that still get you into that professional trading role. So that's the CFA, the SIE, Series 65, Series 57, and those CFA certs. It's like being a CPA, the CFA, a chartered financial analyst. And then you can go and work for darn any investment firm and do whatever. And then the FINRA certs, the SIE Series 65 allows you to have accounts under management, charge a
Whoa, hold
management
on. You
fee.
going too advanced and you gotta go ahead and son. You going on another tangent.
Yeah, it is. It is. It is. But I'm just letting y'all know the hustles don't stop. They keep going.
Yes,
Shit.
sir. And I'm gonna be right on
Jay about to be a broker.
the journey
Hey, I'm
with you.
trying to
That's
get
right.
there. I'm trying to get there. I'm trying to get a firm. I'm trying to have y'all trade the strategy better than I trade it. So I can just go get the money and be like, hey, y'all go y'all way. I'm gonna go my way. We going in the same thing. Cornerstone Wealth Management Group as a whole. We just do this and like that one, like the richest black dudes in America. Y'all like I don't know their name, but this is what they do. They're wealth managers and they do this and they do that and they've got you know what I mean? And they're completely inconspicuous. You'll never tell them from a can of paint if you see them walk past you. And that's how I'm trying to be. I'm trying to be like what's the dude name? Ronald Reed, if that's his name. Dude was a janitor. They didn't know he was a millionaire until he died, and then they realized like, oh, this dude built the city library and all the rest. He was like he's the one who made all the charitable donations for like everything in the city. Dude was a janitor
Facts.
and a gas station attendant.
Hell yeah, I'm trying to be like that minus all the extra work.
And, oh, he was doing it for fun because shoot, he was
Yeah, he was
already
doing that
up.
just to get out of the house and stay in probably.
Yeah, and
Nah,
then he's outside where everybody else, nobody's there. The janitor is the last person in, but the most important person because if he don't clean up, nobody can come in the morning. So he there when nobody's there, and he probably knows all of the secrets. Taking that
yeah,
trash out.
yeah. Well,
With everybody
good
thrown
way.
away. But hell yeah, y'all. Hey, I gotta go. I love y'all, man.
Love you too, family.
Sit here. Y'all just hit me up. Thursday I'm not sure if there's anything to trade live, but Thursday, the subscriber group, I'm dropping another Zoom for that group specifically. And we'll go in there trade live. If there's something popping up, we'll definitely trade live. We'll do one live trading day in the subscriber group a week. Um, at least when there's something going on. I don't want to take trades and I'll measure them, I'll grade them. If they're not, you know, above a C, C plus, I'm not going to take them. But I'm looking for the best trades. If I find one, then we'll definitely take it together. And I'll do that with the group. But market mastery on Sunday, this on Tuesday to get everybody right, and we'll do something live. Now that I got a little bit more time. But appreciate y'all for showing up, man. If you build it, they'll come. And yeah, that's all
I
I
got a
got
couple
right
people
now.
coming. I got a couple people coming next Tuesday.
All right. Sounds like a plan. I'll get some more people in there too. I got a bunch of people asking, I want to learn how to trade for my birthday. All right, bring your ass on there. Let's go. Tuesdays for the
Funny.
newbies. So,
Say word. All right.
But all right, fam.
all right, y'all. Y'all take it easy.
You too.
Study.